Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Easynomics. In just a few minutes from now, the government will release the first advance estimates for GDP for FY26. According to a poll of economists, growth is seen at around 7.5% in the full year as against 6.5% in the previous fiscal year. These numbers are crucial as they come a few weeks ahead of the union budget for FY 2027, and they will set the tone for not just the budget math, our fiscal planning and policy priorities, but also a signal to the wider markets and analysts about what kind of growth priorities the government intends to pursue in the new financial years. And joining me to decode the numbers that are just about to be released in a few minutes from now, Saugata Bhattacharya, Senior Fellow of CPR and a member of the Monetary Policy Committee. We'll also be joined by other economists during the show. But starting with you, Saugata, what is your key expectation as far as this growth number is concerned?
Well, Siddharth, thank you very much for having me in your show. Always a pleasure and a privilege. So you know the RBI's, the MPC forecast for FY26 GDP growth, it's 7.3%. And I believe the survey numbers that you mentioned, the earlier numbers in the survey of professional forecasters, that was also very close, 7.2%. So probably expecting a number somewhere like this, but I wouldn't be surprised if it's a little bit higher than that. Given the fact that, I mean, your viewers all know the analysis about the high numbers that we have got in Q1 and Q2 of FY26 because of the low inflation numbers and some of the other things that we have seen. But I do think that what we have seen of inflation, what we have seen in terms of volume indicators, the high frequency numbers, that we expect growth to be relatively robust. And which is very striking, I mean, given the fact that, I mean, this has been a year of a fair bit of turmoil on the external front. So I think these are very creditable numbers.
You spoke about the turmoil on the external front, and as the numbers come in, we'll get to understand that. I just want a sort of insight into some of the other high frequency indicators that do seem to portray a picture of slowdown in GST revenues, electricity demand being negative, and consumption of petroleum products also a bit soft. While the discussion is on FY26, a quick comment about those high frequency indicators and how you read them, Saugata.
So, of course, you're right that, I mean, but I mean, there are some particular reason, particularly the energy consumption, electricity numbers, mining has been weak, as you know, in the first, and we know the IIP numbers that we have seen for mining. That's partly because of the fact that, I mean, the rains have been very good this time. So it was a fairly cool summer. So the demand for cooling was relatively low. The demand for agricultural irrigation pumps was relatively low. So that was one of the reasons for the electricity demand being relatively soft. On GST and other direct taxes, the numbers that we have seen for November also seems to suggest that we are falling a little bit behind the planned trajectory. But that also we know that, I mean, the rationalization of GST, the cuts in income tax, etc. I think the numbers are holding up fairly well. I mean, even given those. So my sense is that the underlying volume growth is still relatively intact, although we have seen the latest the PMI numbers for December, the Purchasing Managers Index numbers for manufacturing and services, that seems to suggest a little bit of a moderation in the pace of economic activity. But together with that, with automobile sales, etc., still the numbers that have come in. Look, the economy seems to be relatively resilient. The question to my mind is the stimuli that have been given, primarily on the fiscal side, but also on the monetary policy side, 150, 125 rate cuts, a lot of liquidity in the system. How long would the demand that has been generated because of these stimuli, how long would that continue to last? Is it 3 months, 6 months, 1 year, etc.? So that's the thing that we need to watch. Of course, there are the other trade deals, etc., that will come about at some point in time that will probably boost sentiment rather than have immediate impacts on trade. But that's one interpretation of some of the soft numbers that you had mentioned.
Absolutely. In fact, as we talk, I'm also looking at the rupee, and it's settled above 90 to the dollar, and that's thanks to heavy intervention by the Reserve Bank of India. Clearly, the rupee also has been fretting for some time as exports have sagged, and it's clear that exporters are not in a hurry to sell the US dollar. A quick comment about the currency, Saugata, if you would like to make.
But not on the currency per se, because I mean, the forecasting, predicting the currency is always a path to perdition. I mean, littered with corpses of currency forecasters that I don't want to go down that path. But the worry is definitely on the external front, as I mentioned at the beginning. And not just the external front. So this is one of the rare instances where our current account deficit is relatively moderate, it's relatively balanced. Yet there's a fair bit of pressure on the currency, and that's obviously coming in from the capital side. So, I mean, that's one area that I think we need to have a lot more debate with foreign investors, local investors, and it's not just foreign investment coming in. I mean, not to the extent in the previous years, but also domestic private sector investment. So, what are the key bottlenecks in these? Because I mean, whatever is happening in the domestic investment front will obviously be showing up on the interest of foreign investors. So paradoxically, the lack of, and remember one particular thing very quickly on the FDI side, which is the most critical, foreign direct investment. Gross FDI flows have been relatively good. The problem with net FDI is the outflows, both from repatriation, the disinvestment part, as well as India's outbound FDI. So we've been trying to get a sense of what is leading to this, but that needs to be investigated in more detail.
Okay. So viewers, as we wait for the data to come in, I want to do a quick recap of some of the other market moving details, including the Sensex ending at just about 84,971, down 0.1%. We also have very clearly the markets looking not just at the macro data, but also the trade related worries. Saugata, in terms of the outlook, in case a trade deal were to come in and at whatever time it would happen with the United States, what kind of macro rub-off effects can we talk about?
So, well, I mean, whatever the framework, I mean, whatever the trade deal, whether it be a framework deal or some part of a carve out or something of the entire the broader comprehensive package, both with the US and with the EU, European Union. I think the first initial impact of the signs of a trade deal, and provided the trade deal is balanced in the sense, so the first impact will be on sentiment. That will probably show up in market sentiment. And then after that, once the details are hashed out or whatever put in place, the tariffs are put in place. So with the trade deal, hopefully the other major thing that will happen is
FY26 GDP growth seen at 7.4% as per first advance estimate. The number that I'm seeing on my screen, and we'll bring it up, 7.4% as per first advance estimate. And clearly the overall economic consensus that we had shown you was 7.5%, but the first advance estimate at 7.4%. Nominal GDP growth seen at 8% in FY26 versus 9.8% in the previous financial year. I repeat for our viewers, GDP growth, the first advance estimate at 7.4% versus 6.5% in the previous fiscal. GVA growth at 7.3% versus 6.4% over the previous year. The GVA growth number, we'll try and bring that up on the screen once again for all of you. 7.3% for the GVA. GDP at 7.4%. So that is breaking news at this stage. And if you look at some more of the data in terms of its fine print, the nominal GDP growth number at 8% comes against 10.1% that was assumed in the union budget for the year that will end on the 31st of March very soon. I now have the sectoral breakups. Before I go back to our guest, I am going to take those sectoral breakup numbers for all of you to absorb. Farm sector, agri growth seen at 3.1% versus 4.6%. So, a sharp dip, significant dip seen as far as farm sector growth is concerned. Mining sector at a negative 0.7% versus 2.7% in FY25. I'll repeat the mining number, minus 0.7% versus 2.7%. Manufacturing sector growth is seen at 7% versus 4.5%. So that's a good performance. As far as the construction sector is concerned, again 7% versus 9.4%. Private consumption growth is seen at 7.8 versus 7.1%. Government consumption expenditure growth is almost double of the previous year's number of 2.3%. It comes in at 5.2%. As far as the services sector is concerned, viewers, the latest numbers see that number at 9.1% versus 7.2%. So clearly services followed by manufacturing, the two stars as far as the growth sectoral composition is concerned. Saugata, quick comment on these numbers, and I'll keep the industry number also that I have as you speak. Industry growth at 6.2% versus 5.9%. So we have numbers for farm, we have construction, we have mining, we have manufacturing, we have services, and we have industry. So it's clear that services is the star, followed by manufacturing, industry holding up pretty decently, farm sector and mining clearly a concern. And these are numbers that one had anticipated over the year. But Saugata, your comments on these numbers.
So quickly, one, I'm very relieved that, we do not have a surprise. The numbers came in more or less as we expected, 7.3 from the RBI, 7.5% in your survey. So that's number one. Second, the reassuring part is that manufacturing seems to have revived. The growth in manufacturing, as he pointed out. So that many people were expecting a slowdown in manufacturing. That hasn't happened. And presumably a large part of that is due to the manufacturing exports. The electronics, Apple watches, etc., that we are now manufacturing together with all project services. So that is one very good news. I'm a little bit surprised with the lower agriculture because this time round Kharif harvest and the expected Rabi harvest, given the sowing pattern, the rainfall, etc., was expected to be high, and horticulture also has been doing pretty well. So I'm a little bit surprised on the agricultural number, if I have caught your number right, 3.1%. So other than that, the financial services sector, I believe that's what you call 9.1%. So that also, given the way that the financial services are computed using the so-called FISM method, based on bank deposits and credit, that is also a very creditable one. And that also, I think, is coming in from the real estate, being contributed by that group, which is the real estate segment. So overall, I think the numbers are very reassuring. And even sectorally, the sectors that we had expected to be relatively weak have outperformed.
Okay. Let me also bring in Siddharth Sanyal, Chief Economist of Bandhan Bank. Siddharth, you've been hearing us and Saugata's views and first comments on the numbers. I'm sure you heard the numbers. So your key takeaway to begin with.
Absolutely. I think Saugata summarized it nicely after you. And there is no surprise, which is a good message. There is a little bit of, even though modest, there is some uptick in the manufacturing number or an industry number in general, which is also a very, very welcome development, even if it is it's a baby step. Services had been strong for India for the last several years, and that continues to be so. My sense is that at some point of time, with the subsequent revisions, there is scope for the agri number to actually go higher. So actually, we can see some bit of upward movement in the eventual year-end numbers, which is very important, and possibly that is, if I get your numbers correctly, which is very important is we get to see the nominal GDP number is actually a very, very low number this time. So that is one interesting factor and slightly unusual, not a surprise, but slightly unusual. The difference between GDP, real GDP and nominal GDP is really, really small at this point in time, which is noteworthy. And that actually leads to possibly a very interesting area that means overall inflation or GDP deflator is relatively low. How exactly policy, various facets of policy, how exactly react to that going ahead in the next few months is a very interesting area to watch.
Siddharth, how would you explain the fact that nominal GDP growth is seen at 8%, which is well over 200 basis points lower than what was assumed in the budget? What kind of implications does this have?
Well, again, as I said, that this is something very unusual for India, that the gap between real and nominal GDP being that narrow. Having said that, it is not that unexpected or shocking in this particular year, because we have seen for a significantly long period of time that several inflation parameters had been consistently very, very low. So it's not shocking. Having said that, what you asked is possibly of particular relevance. That what does it mean? How exactly some of the numbers will be panning out? I think wherever we are talking about some of the nominal variables, for example, when we measure the first example any economist will be giving you, that it possibly adds a little additional challenge in the hands of the government, how exactly they manage their gross fiscal deficit ratio when the denominator, which is nominal GDP, is relatively lower compared to what they had expected or anticipated in the beginning of the year. Some of these areas need to be seen. This should be having some implication for banks' credit growth and deposit growth numbers. This will have possibly some implication of profitability and earnings growth in certain companies. But overall, it's possibly the momentum of inflation had been surprisingly lower, but generally high growth and low inflation is what in a country like ours we aspire for. So we should not be too unhappy also with this particular outcome.
Okay. Saugata, now that this number has been released, the question would therefore be, what kind of assumption do you feel in your personal capacity the government is going to make for the level of growth nominally as far as the next fiscal year is concerned?
So again, I'm talking in my own personal capacity. So we know some of the forecasts of inflation, particularly CPI inflation, for the first half of next year. It's beginning to touch 4%, and it will climb up even more after that, because a very low CPI inflation number, 0.6 for Q3. So it's going to move up significantly above that. So I think even WPI, I think the costs of some of global commodities, local commodities, etc., are beginning to move up. Some metals prices, copper, nickel, some of these prices are going up. Oil will remain relatively moderate, I'm completely certain. So given these, we definitely should expect nominal, well, the WPI and the CPI combination, which leads to the nominal growth, should climb up from the 0.6% that is being estimated for FY26. I'm sure it will normalize to at least, near about the 9.5% to 10% that we have seen in more usual normal periods as we go on into FY27. So I don't know what numbers will be assumed in the budget, but my own sense is GDP deflator will probably normalize close to that 200 basis points, 2% over and above the real GDP in FY27.
So, just as a quick follow-up to that, does this also pose a risk to the fiscal deficit number and that calculation?
Unfortunately, yes. Coming in from both sides, both from the lower nominal growth. Remember, if I remember correctly, the nominal growth assumed was 10.4% in that.
10.1%. 10.1%.
1%. So given that, and we are getting a 8% growth number, so that is one part of distortion in the fiscal deficit numbers, the ratios. The other thing is the actual tax collections on the revenue side, both from the direct as well as indirect revenues, given the GST and indirect tax rationalizations and exemptions that have been given. So from both sides, one is as an algebraic measure, and the other as actual collections. My sense is that there might be a shortfall in the fiscal deficit numbers, the 4.5% target that we have seen. So that probably, my own sense is, my own personal predilection for this is that the government should probably more or less keep the expenditure levels at levels that they had budgeted for, even if it means a slight slippage in the optics of the fiscal deficit number.
Okay. Siddharth, weigh in on the very same point. Do you kind of concur with Saugata on the fiscal deficit front?
I'd be having a similar but a slightly different take. It's very true. When the government, in a year when the government has given so much tax relief to people in various forms, that actually is some kind of a headwind to revenue growth. Also, the nominal GDP, slower nominal GDP growth means that leads to some kind of a challenge or headwind for the government to meet their fiscal deficit ratio target. Maybe even with the, as we all can work out, with the same quantum of fiscal deficit in rupees crore or rupees trillion, it might mean a slightly higher percentage of gross fiscal deficit to GDP. That's a reality. Also, that these days the government is also very, very committed not only to the fiscal deficit target, also the public debt to GDP number also is another additional commitment the government has set out for themselves. Now, while there are challenges to these two particular ratios in the hands of the government, where I draw a lot of comfort from is the track record of the government. That the government has, in various situations, the government has actually managed to stick to their fiscal deficit target. And these days, there is a lot of expectation thus for the public debt to GDP ratio also. So while I completely agree with Saugata that there will be, these are very clearly headwinds, there are clear headwinds for overall fiscal deficit management. The government's track record would actually give you a lot of confidence that they have avoided slippages. Having said that, the kind of zone where the fiscal deficit targets are there in the low 4% kind of a vicinity, there is not too much of a harm even if we miss it by 10 or 20 or 15 basis point. But more often than not, or almost always, they have been very, very meticulous in meeting that, if not overachieving.
Saugata, with this kind of backdrop, and this is of course the first advance estimate, but till February 28th we'll have to live with these numbers only. What kind of nominal growth number can we expect in the forthcoming budget for the next fiscal?
So again, as I mentioned, Siddharth, that my sense is that they will be taking forecasts from a lot on inflation and thence the deflator, GDP deflator, from a lot of sources. So I'm sure from the Reserve Bank, from other sources, government think tanks, the Chief Economic Advisor's Office, etc. So all of that. My own sense is that given the forecast of the Q1, Q2 of next year, and hopefully we'll be at around a 4%, 3.5% to 4% level for the CPI, and more or less 2.5% to 3% for the WPI in next year. And given the preponderance of the WPI in the deflator, my own guess is that they will be sticking to somewhere close to about 10%. Let's keep it in the range of 9.5% to 10.5%. I think it will be on the lower side, but my presumption is that that's the working range that they will be looking at for their forecast, for their projections.
Okay. Siddharth, if you want to jump in on that, please do. Otherwise, I have a question to look ahead with you.
That is, we have a very similar expectation that these days, I would say, next year you can expect partial normalization of that particular gap, So somewhere in the range of 2 to 3 percentage point kind of additional, gap between nominal and real GDP. So somewhere just around the double digit plus or minus is possibly a very, very realistic estimate for the upcoming budget for the next financial year.
Okay, Siddharth, I'll stay with you because I did right at the top of the conversation bring these numbers up with Saugata, but I want your view. So data that I have with me here, and I'll just kind of read it off for our viewers to absorb. So if you just take September, October, November, 3 months data for GST revenue, we know the reasons, but just look at the number. GST revenue has shown a very sharp slowdown, 9.1 to 4.6 to 0.7. If you look at electricity demand, it was actually negative in October and November, and petroleum consumption was negative in October and November. The question therefore I have for you is, as we head into, and the budget preparation is already underway, what kind of policy priorities do you expect the government to follow? One, on revenue, and as far as its spending priorities are concerned. Siddharth, with you first, and then the same points I will go to Saugata.
I think, Siddharth, the government has actually made its priorities pretty clear. It has actually come on the front foot to provide some bit of support for growth and growth momentum more often than not in the last several months or last several quarters. And given the fact that several other constraining factors had been very well under check. For example, inflation had been very well under check. Fiscal deficit, at least at the central level, had been very well under check. And generally current account deficit had been very well under check. It actually offers the government that much of liberty to do that. I don't see that particular pattern changing anytime soon. So wherever possible, there will be support from the government in terms of, boosting the growth momentum, which we can take a lot of comfort from and pride in possibly. So that part is very, very, very clear. And sorry, Siddharth, there was a second part of your question.
Essentially that in terms of the priorities that you expect the government to follow as far as spending is concerned.
Well, I think that part is clear. The government will possibly continue to provide support to growth wherever possible. Sorry, I missed the first part of your question, which is
which was about revenue.
The three high frequency indicators.
Revenue mobilization.
And also the GST revenue. So GST revenue will have some bit of, we know that this is some kind of a headwind so far as the government revenue is concerned. We all acknowledge that very clearly right in the beginning. However, I would say that we need to see these data points with a pinch of salt, because it should not be seen as necessarily any big dip in the momentum of growth, because obviously September onwards there has been a significant GST relief. Also, there had been some bit of holiday realignment during the month of October in this particular year. Diwali holidays shifting in October rather than November in this particular year. These things from a month-to-month basis do impact some of these high-frequency numbers. So we should not be overtly concerned about whether some of these variables do indicate any major loss in momentum. Rather, my sense is that given there are multiple channels of policy support, the growth momentum by and large remains in place. There are challenges from the external side. There are challenges from some of the factors like weather aberrations happening more often than not. But apart from that, I think overall the growth momentum also remains broadly in shape.
Okay. Saugata, as we wind down the conversation, explain to our viewers something that they may have heard, read, which is a Goldilocks phase for India's economy. Since we are speaking at the top of the calendar year, and all of you economists are more in tune with financial years, fiscal years, from a calendar year perspective, how would you describe the possibilities for the Indian economy in 2026?
Well, I mean, a tough one as always. 2025, calendar 2025 was not so good. I mean, despite the headline growth numbers, etc., I mean, there have been multiple challenges in the system. So, one very good thing that has emerged out of the 2025 policy response is this coordinated, cross-sectoral, across-the-board reforms that have been put in place. And 2026, given everything else, given even assuming that nothing happens on the US trade front, trade deal, or whatever, even assuming that, I think the effects of some of these measures will begin to start showing up in calendar 2026. There are likely to be multiple challenges, but if over and above this, there is an improvement on our trade front, the way that the global capability centers are coming in, boosting services sector growth, that probably also is getting dependent on will have an effect on manufacturing. And most particularly, the standout number that comes out from the GDP this time is the growth in personal consumption expenditure, PFC as it's called, 7.8%, as you pointed out. So that's a clear reversal of a trend that we have seen over the last 3 years of growth in that segment coming down. So I think that augurs well. What the government is losing out in revenues is getting transferred. It's very clear in this number to the private sector, to the households, and that probably is also going to play a role in 2026.
Okay. Siddharth, that very same question to you.
No, that's very true. Some of these factors which have started seeping in the background, they typically work with a little bit of lag for a few months. And possibly the bulk of the benefits in terms of the lower GST collection, GST tax rate, or even the lower income tax rate, all these things will possibly show some result. And as Saugata said so rightly, that traditionally, in case of India, the bedrock for growth is private final consumption expenditure, or PFC, the way we normally refer to it. So PFC typically in case of India is rock solid, typically contributes 5 to 6 percentage point of growth by itself, which had been significantly weaker in the last 2 to 3 years, which seems to be making a turnaround, which is very, very heartening, because the large contribution of PFC actually constitutes the bedrock. And on top of that, the delta comes typically from either investment and net exports together. But PFC coming back to its old glory is possibly a very, very strong message for India, and some bit of reiteration of its granular growth momentum.
Absolutely. And as our guests have been saying, 2025, despite all the challenges, all the tariff turmoil and volatility in the wider external front, it's clear that the government and, as Saugata Bhattacharya said, multiple entities, regulators included, have moved, and 2025, when we look at it in our rear view mirror, was clearly the year of reform. But the expectation is that that momentum will continue and hopefully pick up pace in calendar 2026, because there is still a lot that is left to be done. And beyond today's first advance estimate for the current financial year, we will wait for the budget, and after that, the new GDP series. Saugata Bhattacharya and Siddharth Sanyal, thank you very much for your time with us today. With that, it's a wrap on this episode of Economics. We'll be back with more. Until then, goodbye.